A Pan-African future. Together. EcoBank. A better way. A better Africa. Across Africa, a new era has begun. A shifting our focus to a new horizon. Together, connecting us with one EcoBank. A better way to create and share opportunities to grow. Across Africa, a new era has begun. A shifting our focus to a new horizon. Together, connecting us with one EcoBank. A better way to create and share Africa. Today, we are making a brighter tomorrow, built by our dreams and our energy. Across our continent, across the world, we are creating a better way to a better future. A Pan-African future. Together. EcoBank. A better way, a better Africa. Across Africa, a new era has begun. Shifting our focus to a new horizon, connecting us with one purpose, to create and share opportunities to grow. Today, we are making a brighter tomorrow, built by our dreams and our energy. Across our continent, across the world, we are creating a better way to a better future. A Pan-African future. Together. EcoBank. A better way, a better Africa. Across Africa, a new era has begun. Shifting our focus to a new horizon, connecting us with one purpose, to create and share opportunities to grow. Today, we are making a brighter tomorrow, built by our dreams and our energy. Across our continent, across the world, we are creating a better way to a better future. A Pan-African future. Together. EcoBank. A better way, a better Africa. Across Africa, a new era has begun. Shifting our focus to a new horizon, connecting us with one purpose, to create and share opportunities to grow. Today, we are making a brighter tomorrow, built by our dreams and our energy. Across our continent, across the world, we are creating a better way to a better future. A Pan-African future. Together. EcoBank. A better way, a better Africa. Across Africa, a new era has begun. Shifting our focus to a new horizon, connecting us with one purpose, to create and share opportunities to grow. Today, we are making a brighter tomorrow, built by our dreams and our energy. Across our continent, across the world, we are creating a better way to a better future. A Pan-African future. Together. EcoBank. A better way. A better Africa. Across Africa, a new era has begun. Shifting our focus to a new horizon, connecting us with one purpose: to create and share opportunities to grow. Today, we are making a brighter tomorrow, built by our dreams and our energy. Across our continent, across the world, we are creating a better way to a better future. A Pan-African future. Together. EcoBank. A better way, a better Africa. Across Africa, a new era has begun. Shifting our focus to a new horizon, connecting us with one purpose: to create and share opportunities to grow. Today, we are making a brighter tomorrow, built by our dreams and our energy. Across our continent, across the world, we are creating a better way to a better future. A Pan-African future. Together. EcoBank. A better way, a better Africa.
Hello, everyone. Welcome to another episode of my SME Growth Series powered by EcoBank. My name is Simsola, and I'll be your host for today's session. The speaker for today is Bolanle Afolabi, who is a partner with KPMG. She has over 18 years experience in accounting, financial reporting and control, as well as change management for startups and multinationals. Today, she'll be taking us through the topic financial management for SMEs, and we'll be covering 3 key areas, such as budgeting as a tool for financial planning, costing and pricing strategies, and analyzing the financial statement. It promises to be an exciting session, and I hope you enjoy it. I'll be handing over to Bolale Afolabi now. Thank you.
Hello, everyone. A very warm welcome to you for joining my SME Growth Series powered by EcoBank. Today, we'll be focusing on financial management for SMEs, which is a very crucial area of interest for every progressive SME. I'd like to start by paraphrasing a quote from a book I read some time ago, Focus on Financial Intelligence for Entrepreneurs. The indication from that book is, as an entrepreneur, well, even if you understand your business, you understand your market, you understand your employee, you understand your customers, if you do not understand financial management, you are still operating at a disadvantage in the world of business. Given this background, I'm aiming to achieve 5 key objectives at the end of this session. I would like to emphasize how important it is to you as an entrepreneur to understand financial management. After that, I will also discuss how you can use budgets as a tool for financial planning. I will then continue to explain how you can determine an appropriate costing and pricing strategy for your business. And I'll close with generating the financial statements and analyzing it to make informed decisions. To provide a background and a context to financial management, I'd like to broadly define it as those activities that involve planning, how you plan your financial resources, how you organize your financial resources, how you control the financial resources of your organization, of your business to achieve your goals. Planning your resources effectively helps you to be able to determine whether as a business you are profitable, you are growing in the direction in which you have set, and you're also making the right decision. Whether you're selling products or you're providing service, it also enables you to be able to make the right decisions in terms of your product mix and your service mix as well. And finally, as you expand in your business and you need finances, it also provides you the right documentation for you to be able to get the finances that you require. So this of course, linking it to the initial context I mentioned, it buttresses the fact that you cannot, as a business owner, ignore financial management. It's a critical area and a fundamental aspect to ensure the success of your business. In explaining financial management, the expectation is not for you as an entrepreneur to become an accountant or financial expert, but you need to understand the basics. I will be discussing financial management from 3 key aspects. The first one is getting the basics right. It's very critical as an owner to understand the basics of financial management, and we'll talk about the 4 core areas of the basics. Then subsequent to that, I will then explain when you get your financial information, how do you perform financial analysis, which will then aid your business decision as an entrepreneur. And finally, beyond your internal information, what other big picture should you be considering for your financial management decisions? Starting from getting the basics right, there are 4 key elements to be considered. And the first one is budgeting as a tool for financial planning. And of course, how do you then ensure that you are implementing the right costing and pricing strategy as a business? Then I'll go ahead to discuss bookkeeping and financial reporting fundamentals and close it with tax compliance. Right. Whether you are starting a new business or is an existing business that you want to grow, or you want to diversify into a new business entirely, you need to plan first. And that's the word for every SME and every entrepreneur. Plan first. And planning, a tool for planning is your budget. Budget is really a formal expression of your goals, of your strategic intents in quantitative terms for the near future. And it requires you to be able to project your revenue and your expense to determine the direction of your organization. In coming up with your budget, of course, you will then have to have an in-depth understanding of your markets, of your customers, and the opportunities that exist in that market, which then enables you to focus on the business and ensure that you are tapping and taking advantage of the opportunities that exist. Of course, preparing the budget also, bring to your fore in terms of the challenges that may occur in the near future, and you're able to put in assumptions and action plans to navigate these challenges. Which enables you to be able to use budget for your planning. So my first key requirement of an SME really, we are in the middle of the year, it's never too late, but the first requirement really is to have a budget which is the projection of your revenue and your expense for the year, and then that forms the strategic direction for your organization for the year. In developing your budget, there are 4 key steps that you can consider. The first one is really to set your business objective. So as a business, you want to consider what objectives you would like to achieve. It could be growing your revenue base or customer base, or achieving certain percentage from a profitability point of view. Whatever business objective, that's the first step in developing your budgets. Subsequent to that, you then, of course, use this information to do a forecast for your revenue and information and costs. In performing the forecast for your revenue and costs, there are key areas that you need to consider. Of course, historical records comes to play, and of course, you also look at what are the other future influences that can impact your revenue and sales. Some of the things that you can look from an historical perspective is to look at your trends, also look at if there is any seasonality that impacts your business, and consider all of those. And as you project into the future, you need to also consider the economic outlook of the economy in which you operate, as well as if there are changes in your customer preferences. This enables you to be able to put in appropriate forecasts for your revenue and costs. The third aspect is then, of course, then putting together the budget, as well as the assumptions and action plan. This enables you to be able to review the basis of your budget, whether the assumptions are realistic, and of course, if there are gaps, you are able to document the action plan to enable you actualize the budgets. So it's very critical that these are done as part of your budgeting process. And finally, of course, the budget is then communicated to the right employees and every individual that has input in ensuring that it is actualized. I will be closing this subsection by saying that without a plan, you are running your business by trial and error. 2 key takeaways that you can take away from this first area is to, as a team, as a business, you can relook your business, and then, of course, have a brainstorming session with your manager to prepare an annual budget for the year, which you can break down into monthly targets, and subsequently on a monthly basis, review your actual performance against the budget and check where there are gaps and begin to take corrective actions. This enables you to be able to implement this fundamental financial management practice immediately. Once you've gone through the 4 approaches discussed earlier, you can arrive at any of those 4 key pricing strategies. The first one is your cost-based pricing, in which you've determined the margin that you want to make from your business. And of course, you then add it on top of your costs to determine the pricing for your product or service. The second one is a market-based pricing. Beyond your cost base, you can then match this to what your competitors are charging, and you can use that to adjust the price for your products. The third one is value-based pricing, which is based on the value that you've placed on your products and, of course, the customer's perception of that value. So that can then determine whether you should go to the market with a value-based pricing. And the final one is the penetration pricing, which is mostly applicable when you're just introducing a new product and you're trying to capture the market or gain market positioning. You can go in with a very low cost, and of course, you gradually increase the price over time. So it's very critical as a business to understand your product life cycle or your service life cycle and be able to determine what pricing is the best fit for each product and for each service at each point in time. 2 key action steps that you can take away from these basics is for a business, try and understand your cost components and what is driving those costs, and begin to consider innovative ways to minimize and optimize this cost. The second area is to look at your products and your services. Are there ways that you can assess the pricing strategy to be sure that they are fit for purpose? And if they are not, you can then consider the 4 options that I've discussed earlier and see which one is more appropriate for your business and for your product at that particular time. Moving on to bookkeeping and financial reporting. Now that you've done your budgeting, you've also determined your pricing and costing, it's also important to then track and record all your expenses and income in this organized manner. So bookkeeping enables you to be able to record and track all your income and expenses in a consistent and organized manner. Of course, bookkeeping is governed by accounting concepts and conventions, and a number of gaps have been noted, even for a number of SMEs, around maintaining proper books. I'm going to talk about 4 key concepts that are of importance for you as a business. The first one is the business entity concept. When you are recording transactions, the transactions are recorded for the business as a separate legal entity, separate from its owner. One gap that we've seen with a number of SMEs is the commingling of transactions of the business with their personal transactions. So it's very important to maintain proper records for the business. Where there are transactions between the business and the owner of the business, those should also be recorded accordingly, either as debt or equity, depending on the terms of the arrangements. The second concept I would also like to mention that is critical as we maintain proper books is the money measurement concept. This concept indicates that for financial transactions, only transactions that can be measured in monetary terms are recorded. Of course, when you have skilled resources, because they cannot be measured in financial terms, you are not able to record those and put those in your books. But of course, their skills can then be used to generate revenue, which ultimately then gets recorded. The third area I want to talk about is the accrual concept, which is also an area that we see gaps in owner-managed business or with SMEs. Accounting transactions are recorded on accrual basis. So transactions are recorded when they occur and not when cash is received. This implies that you do not record your transaction on cash basis. You record your transactions when they have occurred and you've performed your performance obligations. The final one is the going concern concept. For a business, once you keep your books, the impression that you are giving to the owners and the users of your financial statements is that your business will continue to operate in the foreseeable future. So where that is not the intent, then you do not prepare your books on a going concern basis. There are other key accounting concepts, but this fundamentally forms the baseline for preparing financial statements. For your financial transactions, they can only be categorized into 5 critical elements. We have your assets, your liabilities, equity, expenses, and income. The first 3, which is your assets, liability, and equity, enables you to be able to determine your financial position as a business. while your income and expenses enables you to be able to determine your financial performance as a business. Every transaction that happens within accounting can only fall within these 5 key categories. I'll quickly explain the categories so it's clear what it entails. So your assets are all the resources that you control as a business, which is able to generate future economic benefits to you as a company. So if you have inventory, for example, if you have a building, if you have equipment, all of those are assets that are owned and managed by the business. The second one is your liability, which is your obligation to third parties. So the amount you hold to your third parties are your liabilities. So amounts owed to your suppliers or even to tax authorities, those are your liabilities as a business. And equity is your stake as an owner in the business. So whatever you contribute as capital into the business remains your equity. The 3 combined areas gives you your accounting, gives you your financial position, and you then see the accounting equations, which shows that your assets is equal to your liability from an equity. So your assets is a combination of what you get from your own contribution and as the owner and from third-party contribution. So these 3 areas gives you your financial position at a particular time for your business. The second 2 areas, which is your income and expenses, indicate your financial performance. Your income is all the inflows that has come to you in a particular period, while your expenses, of course, are the outflow. The difference between your income and your expenses can either be a profit or loss. So depending on the outcome, it indicates how you've performed as a business in a year. And if it's a profit, it increases your stake as a business owner, and if it's a loss, it actually reduces your stake as a business owner. So having this financial information aids you in determining whether your business is growing or your stake in the business is growing or reducing. And it's very critical at this point that these 2 financial reports are measured periodically as the owner of business. You need to understand the elements in your financial position. You need to be able to understand the elements in your financial performance results as well, and be able to perform things that will improve the overall outlook of the business. Another key area of bookkeeping and financial management is your cash flow. Like I mentioned earlier, accounting records are recorded on accrual basis, meaning that your profit does not mean cash. But we know that business operates using cash because cash is king and is very critical to the successful operation of a business. So there's a requirement even as a business owner to maintain a cash flow projection, which actually shows your actual cash that you've received and the actual cash that you need to pay in the near future. Because as a business owner, you do not want a liquidity issue to just come up at any time without planning for it. So a cash flow projection enables you to be able to understand what cash flow are coming in the coming future and what cash outflow are required of your business. In instances where you then realize that you have a negative cash flow, there are certain things you can do within the business to optimize or to create a positive cash flow. One of them is, like I mentioned, profit and cash are not the same, which indicates that you may have sold some of your products on credits or performed some of the services on credits as well. So you can actually offer early payment discount to your customer to improve your cash flow. In other instances, you can also discuss with your vendor to agree other alternative way of making payments to push when you have to make those cash outflows. In other instances, you can see areas where you can increase your prices as much as possible to also increase the inflows that comes to you as a business. So the key message for every business owner is beyond maintaining your financial position, statement of financial position, and statement of financial performance. It's also important to have your cash flow statement to project your inflows and outflow, because it's not an excuse for you as a business owner to say that you do not know that there's a potential liquidity issue. So it's something that is very critical as part of your day-to-day running of your business. Like I mentioned, The objective is not really to ensure that you're an accountant or a finance professional, but you need to ensure that bookkeeping strategy is implemented within the organization. And there are 3 strategies to doing that. Right. The first one is you can employ an in-house accountant who has the right skills and competence to maintain the books, while you, based on your knowledge of financial management, is able to ask the right question and use the financial reporting generated by this accountant. The second alternative is to outsource to an external consultant who is able to bring in the specialized skills and, of course, ensure that you have confidence that the numbers are accurate, and those individuals then ensure that your books are prepared accurately and timely for your use. Finally, you can also use an hybrid approach in which, of course, you have your in-house person record the transaction or prepare initial reports, and you have an external person come in periodically to review the report and ensure that it's in line with the required guidelines that guides financial reporting in Nigeria. So as a business, you need to consider which of the bookkeeping implementation strategy that works for you, but what is critical is you implement at least one of them to ensure that you maintain proper books within your business. And 3 key action steps that you can take away from this section is to, of course, first of all, look at the transaction with your business. Are you commingling personal transactions with the business transaction? If this is the case, you need to do a proper account cleanup and ensure that the books reflect transactions that relate to the business only. The other thing which I mentioned is to identify what bookkeeping strategy works for you and implement that such that financial reports are available for you every month within the 5 to 7 working days by the end of for the month to enable you make the right decisions for your business. And finally, like I mentioned, liquidity and profits are not the same. So you need to ensure that you embed the preparation of a weekly cash flow projection in your business to ensure that you do not have liquidity crisis in your business. On this note, I'll be moving on to the final area on getting the basics right, which is enabling tax compliance. We all know that complying with tax is a requirement for every sustainable business, of course, to avoid penalties and other exposures from a reputational point of view. For taxes, there are 4 or 5 things that you can do to navigate the tax requirement. The first thing as a business is you need to register for taxes. Register for taxes to be able to pay all your relevant taxes. And on the FIRS page online, you are able to see what taxes are available as well as their due dates. Of course, fundamental to ensuring that you are filing correctly is to maintain accurate bookkeeping, which we mentioned previously. And of course, you need to ensure you continue to stay updated on relevant tax laws as it affects your business. Some of the common tax obligations that are peculiar or applicable to SMEs, the first one is your income taxes, in which you pay on your business earnings. Of course, when you earn less than 25 million per annum, then you are not obligated to pay taxes. Between 25 million and 100 million, you pay 20% of your profits. Once you earn more than 100 million, you then pay 30% of your profit as taxes. There are other obligations that are also required of you. When you have full-time employees, you have to pay the payee taxes, as well as, of course, the value-added taxes that are applicable on the goods and services that you consume, as well as withholding tax. But ultimately, to ensure that you are enabling tax compliance within your business, it's also important to see where you can seek professional support to ensure you comply and you avoid penalty as a business. So one key action step that you can take away from the tax compliance section is to ensure your accountants, whether it's in-house or external consultants, they have a checklist of the tax area applicable to your business to ensure that you are monitoring this and complying without exposing your business to risk. Now that we have completed the basic elements of financial management, which is budgeting and planning, costing and pricing strategy, and bookkeeping and financial management tax compliance, we'll now go to how to perform financial analysis. So now you have your financial reports, you've seen your financial performance, you've seen your financial position. What do you do with that information? The first thing is, of course, it's necessary for you to be able to ascertain where you are coming from. So you're able to assess your performance, past performance, and project into the future. You're able to see where you are how you have grown as a business, what are the other growth prospects that are available for you as a business. Also, you're also to check whether from an efficiency point of view, you are operating at that efficiency level. And of course, if there's going to be any issues in the future, you are able to quickly identify those issues and bridge them using your decision making and making those informed decisions. There are 4 key analyses that you can do with your financial statements once you get them. The first one is your profitability. You want to measure how you are performing as a business from a profit point of view. You also want to check whether you are efficient in terms of how you are using your resources. The third area is your liquidity. You also want to be sure that you can meet your obligations as they fall due. And finally, you also want to check how well or to what extent you are relying on debts to fund your operations and your ability to fund and to pay back the debts. It's very important as a business to ensure that your leverage as a business is optimized. You do not want to be over leveraged and then you are not able to fund the debts. So these 4 areas are very fundamental to you as an SME to manage and monitor and ensure that as the indicators are being monitored, if there's any actions that need to be taken to improve on the measurement basis, then you can take in those action steps. Once you've gotten the basics right as a business, the next important item to consider is analyzing your performance results so as to analyze how well you've performed over time. You need to check what's your prospects for growth as a business. How well have you used the resources available to you as a business? And of course, if there are issues that are looming, you're able to identify them quickly and proactively address them to ensure that it does not become a more difficult position for you as a business. So assessing and reviewing your financial statements or financial results is very critical to assess your performance, like I've mentioned previously, as well as check whether you are efficient in the way you are running the business. There are 4 key things you can measure as you review your financial statement, right? The first one is your profitability. You want to check as a business how profitable you are over time and whether you are growing from a business perspective. The second area you also want to check is how well you've used the resources that are available to you as a business and how well you have utilized them in generating revenue and future growth for the business. Another key consideration is your liquidity. Like we mentioned, profits and cash are not the same because accounting transactions are recorded on accrual basis. So it's also important to be able to measure how liquid you are as a business and your ability to be able to meet your short-term obligations based on the cash flow that is being generated from the business. And the fourth but not the least is on your financial leverage. You want to be sure that the extent to which you are relying on external debt to run your business is not too high that you're unable to manage the debt or pay back the debts. So it's very important as a business to monitor matrices around these 4 key areas. Some of the key considerations that you can use for profitability is your gross profit margin. You want to check how your revenue is covering your direct costs. You may also want to check your net profit, which is what's the ability of your revenue to cover your total costs. Of course, you also want to check how well you've utilized the assets that has been put in place, that has been utilized within the organization. So you want to check how well your current asset is able to cover your current liability. And of course, finally, you also want to check how efficient you are from a business. One key area that is very important as an owner-managed business is to check your average collection and average payment period. You want to be sure that your payment period, your collection period is earlier than your payment period, so you're able to meet your financial obligations to your suppliers. And of course, like I mentioned previously, your leverage is also a key requirement for you to check. You want to be sure that your debt to equity ratio is optimized. It's very important as a business to identify the key financial ratio metrics that are important to you as a business and monitor them. And as you see any issues that you need to address, you proactively address these issues to ensure that the business continues to run as planned. Beyond the direct analysis covering these 4 areas that I've just mentioned, it's also crucial to identify early warning signals, which helps you to identify if there's going to be any anomalies or failures before they occur. As you review your financial information and you notice decreasing profit margin, for example, you want to check whether it's just a short-term decreasing margin or is an indicator of a long-term issue. For example, it's possible that your sales is actually declining due to the competitive environment, or you are not managing your operating expenses as you ought to do, or you have a high debt servicing and costs that you need to manage properly. So it's very important to understand why your profit margin is decreasing, because this can potentially lead to a going concern matter to the organization. The other area is, of course, your negative cash flow. If you have a consistent negative cash flow, despite the fact that you are making profit as a business, it's also an indicator of whether there is an issue in terms of your receivable collection. Of course, if you are not collecting your debts or from your customers, you are not able to actualize the cash flow into the business, and eventually you may have liquidity issues which will on the long run impact the business. So it's also important, where there is consistent negative cash flow, to be able to identify the root cause and identify whether it's just a seasonal short slowdown which will eventually pick up, or is an indication of a longer time issue which needs to be proactively addressed as well. The third area is, as a business that is involved in the sale of goods, you also need to check that your inventory level is at a reasonable level. Once there is a consistent high inventory level, you also want to check and be sure that you do not have obsolete items that you are not able to sell, or you are not over trading or overstocking items and thereby tying down your capital. So it's very important, as you analyze your financial statement, to also look at trends of key financial matrices that matters to your business. And one last one I will also mention, which is also closely linked to your assets, is when you consistently have increasing receivable levels. You want to be sure that you are dealing with the right customers that are able to pay the value that your services or products deserves, and they are paying on time, so you can meet your obligations to your vendors, to your employees, and also to yourself as the business and to the provider of capital. So 2 key takeaways that you can implement from performing financial analysis as a business is to identify 2 to 4 key financial matrices that matters to you as a business and will have the most impact on your business, and monitor and manage these matrices on a monthly basis. Of course, this will enable you to be able to focus on issues that matters for your business. The second area is then to institutionalize monthly performance review with your core team to review how you are doing well as a business, and consolidate on your strengths, and where there are areas that you need to improve, you then implement strategies to turn around those areas. So it's very critical as a business to ensure that these performance reviews are done consistently in a manner that helps to grow and transform the business. The last area, which is also critical to financial management, is considering the big picture. So in considering the big picture, there are 4 key areas that as a business you need to focus on. The first one is the economy and the industry in which you operate. As a business, understanding how the economy and your industry impact your business is very key, because doing that, you are able to identify the opportunity that exists as well as the threats in a changing environment. The second critical area is your competition. As businesses do not operate in isolation, you operate in a competitive landscape. It's very crucial to understand how your competition are doing so as to stay ahead of competition. This also helps you in defining and relooking your pricing strategy, as well as improving your overall financial performance. The third critical area is regulation. As businesses, we manage risk to ensure that our business continuity are not in jeopardy. So one of the things is to be conscious of the emerging regulations that impact your business, and you're able to manage this risk and ensure you comply with relevant regulations that impact your business. And finally, your customer needs and expectations are also very crucial. Businesses operate for customers, so you need to ensure that your customers' evolving or changing needs and preferences are considered to enable you continue to retain your customer, retain your market position and positioning, and continue to penetrate the markets. So considering these 4 elements beyond your internal financial information is very crucial as a business, and it's a subject matter for every entrepreneur and SME to consider as they review their monthly financial information. So in summary, the key messages that I would like every listener to take away from this session is understanding the basics is critical to mastering financial management. You cannot adopt sound financial management within your business without understanding the basics, which covers budgeting and maintaining proper financial information, ensuring that you comply with tax, and adopting the right costing and pricing strategy. Without a plan, you are running your business by trial and error. So starting with a plan is non-negotiable for you as a business. And as an organization, it's also important to institutionalize monthly performance review and analysis to enable you identify anomalies even before they occur. And considering the bigger picture beyond your internal financial information is critical to enable you make a holistic and informed decision. On this note, I would like to say thank you for listening.
Across Africa,
Thank you so much, Balale, for this very insightful session. And I'm sure everyone on this call has learned one or two things to better manage their finances and their business. So, Balale, we have a few questions that have come in, and I'm going to take them one after the other. Balale, can you confirm that you can hear me, please?
All right, thanks.
Can hear me? I'll be going ahead to read the questions that have come in. So the first question says, is there a recommended app for bookkeeping? I need an app to help me calculate how much profit I've made every month in addition to inventory management. Thank you.
All right, should I take the questions one after the other? So for
Yes,
bookkeeping, okay. So for bookkeeping for SMEs, two major considerations. You need to look at the costs, the user friendliness, as well as the flexibility. You want something that you can use even while on mobile apps or on your phone. So you can consider the typical low cost accounting software, such as Sage 50 or QuickBooks. So those you can use you can even scale it as your business scales up. You can also consider some mobile apps like Zero, Fisky as well. So it depends on your budgets. It depends on what you want the software to do for you. But there are a lot of options online that are very flexible from a payment standpoint and will still allow you to achieve your financial management goals. So yes, I hope that answers the question.
Yes, please. Thank you. I'll be going ahead to the next question. It
Okay.
says, how can an accountant working in the SME space assist SME owners to be financial with their financial management, considering that the owners have sole access to approvals of payments and can make other sole decisions without the accountant's knowledge? Thank you.
All right. So one of the things we can do to make the owners financial management conscious is in the delivery of our outputs. Sometimes, even as accountants, we are not delivering quality reports, timely reports, and generating insights from the outputs that we deliver. So to enable the owners understand and appreciate what we are doing, put a timeline to say every month I'm delivering reports to the owner. I'm also sharing some insights that the owner can then appreciate, that if this is done frequently and well done, he or she is able to make the right decision for the business. So I think it starts with us as the accountants in an SME business to first deliver excellently. Once that is done, our work will speak for us. And then you are able to then get the owner to be more interested in financial management. And of course, as we run sessions like this, which is not for accountants only, is also for the owners. The owner is also able to appreciate the importance of financial management practices. So I think the answer really is, it starts with you. Deliver excellence, deliver quality work, make your impact felt, and then you'll be able to make the owner to be interested in financial management practices.
Thank you, Bolanle, for that. Another question says, my business is still at the growing stage, got few customers, and we are 1 year and 6 months since registration. When we will be expected to pay tax?
So annually, you need to file tax on an annual basis based on preceding year basis. But of course, based on the Finance Act, if you are not yet making up to 25 million, you will not be expected to pay. But of course, you will still file your returns. So it's until you cross the 25 million benchmark, then you are not required to pay tax. But of course, tax is done on preceding year basis. So given that you are 18 months, you need to still file, but then it depends on your revenue at this point. If you've not crossed the mark, you will file new returns and you won't be expected to pay taxes if it's less than 25 million. The only exception is if you operate in the oil and gas. So irrespective of whether you cross the 25 million mark, you are still required to pay taxes. That's the only exception. So any other sector, you are within the 25 million range.
Okay, thank you, Bolanle. Another question says, how can SMEs build a strong credit profile to secure loans at favorable terms?
Okay, all right. So one of the things, if you look at banks, and we are talking to EcoBank now, one of the requirements is your ability to even keep and maintain proper records, right? And they also want to see the growth prospects of your business. So financial management is critical to being able to keep this trajectory of your credit history. So you're able to show the trends of your performance in the last 1, 2, 3 years, depending on the requirement for the loan. I think it's very critical. So as SME, one key thing is keep your records. Focus on your business so that there is growth, because no bank or no investor will invest in a business that does not have growth prospects. So once you're able to demonstrate the potential growth in the business and you're able to keep records over time that can confirm this potential growth, I think that's one way you can also build credits. You can build that credibility for lenders to be able to invest, or investors to invest in your business. So the rest will then be dependent on what the lenders require, but that's very fundamental.
Okay, thank you, Bolanle. Another question here says, as a practicing accountant, what can you do to ensure that businesses embrace the idea and the need to maintain proper records and ensure monthly review? We find out that most SMEs are paying lip services to this critical aspect, and it is highly vital in their business.
Okay, like I said previously, showcasing our capability and our value is in our hands. Sometimes, I've worked with a lot of SMEs, and some of them do have accountants. And when you interact with some of these accountants, the outputs are not of the right quality. They are not accurate. They are not generated timely. And all you see are figures that does not provide insights for the owners to make decisions. So once the quality of your output is not great, there is no way you can convince an owner that it adds value to him or her. So I think the first step really starts from us, start with us as the practitioner, to say, what value am I adding to the business? My information that I'm providing, is it correct? Does it come on time? Is the owner able to see how much profit I'm making? Am I going to have liquidity issues? Am I going to be able to take, do I need additional funds to manage my business? Do I need to go for new client visits and all of that? So what type of insights are you generating for the owner, for the person to have interest in what you are doing? So it still lies with us. So it's for us to relook what we are doing, what we are generating, and how we are presenting financial information. Sometimes when you listen to some accountants, they speak language that is also difficult for the owners to understand. So how are we also communicating the results that we have prepared? How are we communicating it in a language that they do understand, and they understand how it impacts their business, their strategy, and overall growth impact? So it's very critical for us to relook what we are doing and be sure that it's adding value and making the right impact to the owner. So it still goes back to us.
Okay, thank you. Another question here says, this is a two-in-one question. It says, I'm a business owner, and as a business owner, how often do I conduct cost benefit analysis to make informed decisions on taking up new projects or investments, and what factors should be considered in doing the cost benefit analysis?
Okay. So for every project, so there is no frequency. It's just for every project or for every critical activities, it's important to do a cost benefit analysis. So for example, you are opening a new store, just for an example, you want to check whether the cost of opening that store in that vicinity vis-a-vis the revenue you will make from the customers that you would attract is worth your while. So for every significant project, it's important to do a cost benefit analysis, because businesses are run to make profits. So except you have not for profit business, if you are a regular business that is structured for profit making, it's important for every critical decision and critical activities to do a cost benefit analysis. And for your cost benefit analysis, you need to consider both the potential revenue and your costs. Of course, a number of them are going to be based on forecasts, but like I mentioned, forecast is based on your historical information and future trends that you see that will impact the business. So it's not a one cap fits all. So you need to look at the particular scenario and see what are the historical trends that will impact the business and what are the future trends as well, or future trends that will happen that will also impact that particular project. And you consider both in making an informed decision. Can you hear me?
Yes, thank you,
All right.
Bolanle. Thank you for that. Another question says, how can I ensure consistent and positive cash flow to avoid liquidity crisis?
Okay. So for cash flow, like I mentioned, I think in one of the slides,
Yes.
no business owner should say that cash flow issues came unaware, because for cash flow management is something that you need to embed in your process to be done at the minimum on a weekly basis. If your business is also very cash intensive, you may even need to do it on a daily basis. So depending on your business structure or business model, you may have to do daily or weekly. So some of the things you can use to improve that is, of course, you need to consider things that would enable you not to pay early and things that will enable you to receive cash early. So some of the things you can do from not paying early is to renegotiating with your vendors, right? Or your landlord, depending on what obligations that you have. Even loans can be restructured, right? So you look at your outflow and obligations and see where you can renegotiate longer terms. And from an inflow perspective, do you want to consider things that you can do to make your customers or anyone that needs to pay you pay quickly, like giving some early discounts amongst others. So it's not a one cap fit all, but you need to look at your scenario and see what works best for you. But ultimately, what decides for you to maintain a positive cash flow is to look at things you can do to extend your payment terms and ensure that your receivable receipt time is shortened. So it's not a one cap fit all. You just need to tailor it to the scenario and situation of the business.
Thank you for that. Another question says, what do I look out? What are the major financial risks that are associated with my business, and what are the prompts? How do I look out for them?
Okay. So generally, risk are categorized into, key areas. You look at your strategic risk, you look at your regulatory risk, you look at your financial risk. So for risk management, there is no there are general categories of risk, but of course, you then need to look at your nature of business to determine the specific risk. So for example, if I look at financial risk, for example, what are the financial indicators that surrounds your business? So do you have a loan? So do you have a risk of not having sufficient amounts to repay the loan as well as the interest? So you need to look at your specific circumstances and determine the key risks that then impact your business. So a business risk assessment needs to be done coming out from your business model and your business understanding, and then we'll be able to narrow down to those specific risks that impact your business. But on a general note, you need to look at the strategic risk that impacts you not being able to achieve your strategic objective. You need to look at your people risk. Are there critical people in your business that you cannot afford to lose? How do you manage that? How do you ensure that you don't have key man risk? Are there financial risk? Of course, are there even customer risk? Because you need to check, are you a business that is just tied to one customer? How do you expand your customer base and the likes? So it's really sitting down to understand your business model, identifying the risks that impact that business along the critical areas, and then finding controls and mitigating controls to manage those risks.
Thank you, Bolanle, for that answer. We also have another question here saying, we're in a period of high interest rates, low demand, high cost of inputs. What is your advice for SMEs to survive this kind of situation, and how do we go about it?
Okay. So I would say in this era is cost optimization. That's why it's very important as SME to understand your cost structure, right? So look at the elements of your costs. There are two types of costs, the fixed cost and the variable cost. Of course, variable cost is managed because that is dependent on activity level. So if you have low activities, definitely that won't be too high. But for your fixed cost, can you look at alternatives? And we've seen organizations, right? Some organizations were in high paying environments. They moved to low paying environments just to reduce their administrative charges. Can you look at the way you've structured some of your pay? Can you look at your resources? Are you over-resourced? Are there things you need to manage better? So it's really understanding the elements of cost for you as a business and see where you can actually optimize your costs from a fixed cost perspective, because of course variable is dependent on activity level. And it's not just for SMEs, even for emerging and established organizations. A number of organizations are going around cost-cutting initiatives just to be able to stay afloat and ensure that the business continues to grow. So it's something, that's why this cost is very important for you as an owner. Do you understand your cost structure? Do you have a listing of what goes into your costs? Because if you don't understand your cost, you won't be able to manage it. As you do your cost optimization, it's also good to also look at the top line. Is there any opportunity for you to diversify into other related activities for your business or get uplift from a revenue point of view? So as you look at cost optimization, you also consider revenue upliftments and strategies to ensure that you are able to stay afloat in those challenging times.
Thank you so much, Bolanle. I'll be going to the last question for today. This person says, as a business owner, what strategies can I implement to control and reduce operating costs without sacrificing quality?
Okay, all right. So as a business, so I would then go into the variable costs. So these are costs, maybe they are direct inputs to the output or the solution that you sell as a business. So the first thing really is to look at the elements of cost you want to reduce. So are there alternatives? Because the truth is that when you look at the cost elements, there are actually alternatives that works in the same way the original will work. So are there alternatives that can also work and are more cost effective and will also ensure that you are still continuously delivering the excellence and value that you are known for? So that's the first thing. The second thing is that are there economics of scale that you can benefit from? Sometimes we go low and then we spend more. When you do more and you are more efficient, the unit cost becomes lower. Sometimes the way we structure our inventory management sometimes does not allow us to be efficient and reduce our costs. So do you want to look at your inventory management process and see whether there are areas that you can actually gain from economics of scale in terms of large quantity, and then you get reduced costs? The other area is technology and innovation. Do you want to relook your processes and see some processes that can be streamlined or they are not required, so that at the end of the day, you are more efficient, you spend less time, or you deliver more? Or then also you look at your commodity items. Are there items that are already commoditized that you can leverage scale and leverage existing practice for improvement to ensure that you're able to deliver at a lower cost? So I've always mentioned, for each business, it's very important to understand all your cost drivers, understand your business model, understand your business values. And based on this, you can always sit down as a team and strategize on things that can work. But things that can work are really around efficiency, alternatives, economic of scale, innovation, and use of technology. So you always find things around these 5 areas that can work for your business.
Thank you very much, Bolanle, for taking our time to speak with us today. I know that everything that you have covered will help everyone on this session become better financial managers. We really appreciate you. And thank you, everyone, for joining us on this session of the MySME Growth Series. And I know that as we leave here today, we have taken out 1 or 2 things that will help us become better financial managers in our businesses and help us manage our financial planning better. Thank you so much for joining. Also, please note that this series is an ongoing initiative by EcoBank to train 1 million SMEs. Please look out for the next episode, and we hope to see you there. Enjoy the rest of your day. Thank you, everyone, and bye.
Shifting our focus to a new horizon, connecting us with one purpose: to create and share opportunities to grow. Today, we are making a brighter tomorrow, built by our dreams and our energy. Across our continent, across the world, we are creating a better way to a better future. A Pan-African future, together. EcoBank, a better way, a better Africa.